for running through that stuff with us and catch us up. As Dave said, change sometimes can be difficult, but we're really excited about it. The new offices are going to be really nice, again, more centrally located. We're trying to staff up as much as we can. So our whole goal here is to continue to give you the best resources in Central New York, but we're going to remain family. We're going to remain independent. We are not selling out to private equity. I'm not retiring or any of that stuff out there. So we're just looking forward to trying to get the size and resources to give you guys the best possible service we can. So with that said, let's get to the main gist of things right here, which is the economic outlook here. And of course, best laid plans. It's not working for me. All right. So give me 1 second and I'll play around with what we've got. And,
so I think you have to stop your share. There we go. You got it. You're in.
Got it. All right. I don't know what went wrong there, but okay. So at any rate, first I want to talk about what we're looking at this year as far as market concerns, because a lot of people have worries out there. So I'm going to cover market concerns, then I'm going to talk about what we see as the positives on the market, and then draw you to a conclusion. So hopefully I can get through these fairly quickly. So as we come into 2026, there are certainly things to be concerned about, and we still do have uncertainty about tariffs. As early as this Friday, we might get a verdict from the Supreme Court on the tariffs. Most experts believe that they will get overturned, but we don't know what the remedy would be. There's a lot of question marks. But with that said, I don't think it's going to have a big effect on the stock market. So as we walk through this, remember what I always say. What happens in Washington does not determine what the markets do. It can give it a tailwind if the policy is good. It can give it a headwind if the market doesn't like the policies. But ultimately, it's not Washington that's going to determine it, even though Washington's in the news about 95% of the time. So I do think even though we'll have tariff news, as far as the markets go, it kind of left it behind after the first half of last year. So I don't personally see that being a really big concern. Now, what could be a big concern, and I'll talk about in a couple slides, is inflation. Also, big thing people are talking about, is there an artificial intelligence bubble that can bring the whole market down? I'll give you my thoughts on that. And we've had a really good run here in the stock market. Is it too expensive? And it's true. It's not cheap. We'll take a look at that. And then finally, we'll take a look at midterm elections and how that normally affects the market. Kind of a little giveaway here. It's not actually good for the markets normally. So one at a time, let's take the big ones. So inflation. Inflation is obviously a huge problem, and it's probably the number one concern on people's minds out there. And this is a chart that shows you inflation prior to when COVID hit and then after. So the blue line was our trend line. So generally speaking, inflation was going up roughly about 2%, which is what the Fed was looking for. COVID hit, that's the red line. So that's inflation when COVID hit. So what we see is a lot more inflation than before, but something I want to point out. Most of that big difference came in about a year's time period. So we had a huge rise up in inflation. And while inflation continues to increase in prices, it was increasing before anyways. So the big hit to inflation was actually back a few years ago. The reason it still feels terrible is prices don't come down. It's why inflation is so tough for an economy, because once those prices are raised, they don't come back down. But the stock market right now is not worrying about that big difference between those two numbers. The market is keenly aware of one thing. What is inflation going to be going forward, and not what has been? So if you take a look, this gives us monthly inflation data going back to 2022. We peaked June of 22. Boy, we peaked at a 9% inflation rate. That's huge. But if you take a look, generally speaking, since about 2023, inflation has trended down somewhat, and we've had some ups and downs, but generally we've been between about 2.3% and 3% inflation. Now, that's higher than the Federal Reserve would like, for sure. They want 2% inflation. With that said, to me, it is not enough to stop the Fed from lowering rates this year. And I do not think we're going to see a spike in inflation. I don't think we're going to get to the 2% the Fed states, but I don't think we're going to see a lot more than 3%. And as long as we stay under 3.5%, we don't go above 3.5% for a few months. I think the Fed's got the ability to lower rates, and you'll see in the proposal, the presentation here, that's one of the big things that I think is really going to help us. So inflation, higher than we'd like, still a problem, yes, but not in a big enough problem to upset the stock market. So that brings me to the artificial intelligence. Are we in a bubble? And I kind of wanted to show you some reasons why I'm impressed by AI. So we use it all the time here. This was graphics we had used 2 years ago this month in the presentation we gave to you. So we thought we were being really clever, showing you how artificial intelligence can put together great graphics for you. But it turns out you can see it actually misspelled the caution sign right here. And I don't know what it was doing with Dan over here celebrating, but we thought, hey, that's really great at the time. Let me give you an example now of something we just did yesterday for you. That is artificial intelligence.
It is amazing how far artificial intelligence has come in 2 short years. While this may look and sound like Rick Reagan talking to you, it is not. This is completely generated by AI. So while this proves that AI has come a long way, it is not yet perfect. For example, Rick is obviously much more handsome in person and is much, much, much smarter than the artificial intelligent Rick.
I have no idea who typed that script for AI to talk about, but that is just such a difference in 2 years from us just putting together, what looks terrible graphics now to actually being able to get a video. And that was the way we did this is we uploaded a television segment I did and then just typed a script for it. So all of that was pulled from a video of me, nothing with me doing that. And I think, and it's not perfect yet, but I think what we're seeing quickly, well, that is we're seeing big changes coming down the pike in artificial intelligence. And we're seeing it adopted much quicker than we have seen other technologies. So when we talk about the internet bubble, let's take a look and compare how long it took ChatGPT to get to 800 million users versus the internet getting to 800 million users. So it took us about 2 years. So 2 years after ChatGPT was released, 800 million people were using it. The internet took 13 years to get to 800 million people using the internet. Put the mobile phone down here, that was nowhere near it. The reason I show this is this technology is being adapted and used much quicker, not just by individuals, but by companies than anything we've seen in the past. So when we compare it to the internet bubble, what happened with the internet bubble, and you'll see it on these next slides too, is there was a lot of buzz around it. It was great. They spent a ton of money building out the internet, but as you can see, for years, nobody was really using it in big numbers, whereas ChatGPT, that thing really took right off. So what that means is we built a ton of internet infrastructure out that we didn't need. Stock market saw it, it sold off. And you can see that strictly from here. This compares infrastructure use. So this was infrastructure that was laid in the early 2000s for the internet. Fiber optic cable, it was only getting 7% use. So they built this great thing. Nobody used it. We saw the stocks crash and get sold off. Not the case here. Looking at GPUs, which power the data centers, they got 80% usage now on them. That's why they're building them so quickly. It's not just for future use, it's getting current use. So I see that as very different. We've got a technology that's actually being proven to be adapted, and we need the space for it. The internet, at this point in time, when the bubble was peaking in 2000, it was really just kind of on a hope and prayer. I think AI is on much more solid ground. And when we take a look at it from a stock standpoint, this compares to some of the other big bubbles in history. So if you take a look at the year leading up to the peak of the Japanese stock market back in 1987. Japanese financial stocks went up 164% in 1 year before the crash. US tech back beginning in 2000 went up 104%. So if we think he's had a good tech run right now, on average, it's not been 104%. Our current tech run, you're up about 20% over the past year. So even just on size of moves, I do not think it's comparable. Another spot where it's not comparable is on pricing. If you take a look at price to earnings ratios, that tells us how expensive a stock is. The lower the PE, the more affordable it is. The poster child for the bubble back in 2000 was Cisco. It had a price to earnings of 2010. Now, it crashed, and stuff all ended up getting used, as we saw. People did end up using the internet. Just last year, Cisco got back to its year 2000 high. So that just can tell you how long it can take if there's a real bubble bursting. Take a look at the tech stocks we carry in our portfolios. Apple, 36 PE. Amazon, 32 PE. By the way, Amazon traditionally has been at around a 54 PE, so that looks cheap to me right now. Google, you're at 31, Meta at 29, Microsoft at 34. You get the picture here. Not cheap, but actually by tech standards, fairly cheap. So what that means is the growth we're seeing in those stock prices in these companies is actually legitimate growth. They are seeing big sales growth. The other thing that's really important is, yeah, they're investing hundreds of billions of dollars into data centers. The difference is, compared to back in the late 90s, they can afford to. In the late 90s, there was huge debt being taken on to build the internet. And when it didn't come through, that bubble burst, there's a ton of debt out there. In this case, the way we're playing it, these big companies, if AI doesn't come along as quickly as we want, they've got amazing core businesses. They literally, all these companies literally print money. It's not, to me, the same thing. And just for kicks, I threw on Costco and Walmart. They're more expensive right now. For 40 PE and a 46 PE. I don't know. Who do I think is going to grow more over the next 5 years? Costco, I love it. God bless it. But, my money's on Google, and Google's looking cheaper. So that's why I'm not as worried about the internet stock or the AI stocks, or at least the way we're playing it with the big boys. There is also something, though, that's happened the past few months that made me feel better. There is pockets of the market that I think are overpriced from an AI standpoint. And they're the ones that are taking big risks and have taken on a lot of debt. And two companies that have been big and taking on huge debt and building data centers, Oracle and CoreWeave. And earlier this year, they were the darling stocks. They were going through the roof. We picked another two that are taking on a lot less debt. That would be Broadcom and NVIDIA. All of these heavily involved in data centers and the AI trade. But what happened here in the last few months of the year? We saw a big sell-off in that stuff that I think was overvalued, that's taking huge debt and has huge risk. The other stuff, though, that's not taking as much debt, NVIDIA, Broadcom, they stayed pretty flat the last 3 months. This, to me, again, is a good sign. The market is differentiating between quality companies that are not taking on big debt and companies that are taking big debt. So this is why I don't see a big bubble burst. Now, can we at any time drop 20%? Sure. But are we going to have the 85% sell-off we had in the NASDAQ from peak to trough back in 2000 to 2002? I don't see it with these fundamentals. So count me in the camp of I'm not worried about AI creating a bubble. The other thing we talk about is stocks being expensive, and it does seem like stocks just keep going up and up. It's true, they are somewhat expensive right now, though there's certainly pockets of the market that don't look that bad. But this is neat. This shows you the number of times that the stock market hits an all-time high, going back to 1929. So the green shaded areas are years where it's hitting all-time highs. So what we see is we've hit all-time highs, quite a few in 2024, 38 times in 2025. That may make you go, boy, you can't just keep hitting all-time highs. Actually, you can. From 2013 to the beginning of 2022, that was a great time for the stock market. And year after year, we were able to hit all-time highs. The late 80s, coming into the 1990s, leading up to the dot-com bubble, boy, you can see year after year. So you get the point here. Just because we've had a couple good years, it doesn't mean that the stock market can't continue to do it. And here's a little known fact on things. Over history, you're better off investing in the stock market at all-time highs than you are the average day in the market. And that's because the market tends to run in cycles, and so you can get a lot of appreciation. We think it's still got room to run. I'm not scared away, but it is, again, I'm not being extra optimistic. It is expensive, so we are somewhat priced for perfection. Now I'll bring you to what really worries me. It's a midterm election year, and it tends to be really bad for stocks until we get to a month before the election. So the dark line that you see, that's the other 3 years averaged together during the presidential cycle. So it's the average of what the markets do in a non-midterm election year. Midterm election year is the lighter blue line. So what you see is if we followed a normal pattern, we'd get a climb here through the first quarter and then a pretty significant sell-off until we hit right into about October before the midterm election. So in an average midterm election year, we're negative by October versus being positive about 6 or 7%. Doesn't mean that's an average. It doesn't mean that's what we're going to follow this year. But this is what I would say is a significant headwind that we've got. The industry pays close attention to these trends. So that means the positives I'm going to outline are going to have to outweigh, at least for the first 9 months, some of these negatives. Now, again, the good news is starting the year before the midterms, we normally see a strong rally in the last quarter of the year. And I would expect that again this year. So typically not good for the first 3 quarters. This shows volatility across the different election years. The shaded area is midterm election years. So what you see with that volatility, we normally have not great stock market and a spike in volatility. So in other words, buckle up a little bit, I think, for the first half, if not 3 quarters of this year. And then finally, this I think is one of the most important slides that I can show you. So every year, there's a sell-off in the stock market. You don't know how big it's going to be, but we get one every year. What you're looking at is a chart, and the orange that you see shows you what the average drawdown is during a midterm election year from the peak to the trough. This is some big drawdowns. So what you see in 2002 had a 33% drop in the midterm that year. Now, back in 1974, you had a 36% drop, but you get the gist here. There's some big drops from peaks to troughs in midterm election years. It averages to 17%. I would not be surprised at all if this year we see a drop at some point of 17%. That doesn't mean I think the stock market's going to drop 17%. So we could go up 15% in the first 4 months of this year, then drop 17%, be only -2, then rally back to be 10% up by the end of the year. So I'm not saying it means we're going to be down 17% this year. But what it means is if history plays, we're going to have an average drop of 15 to 17% sometime in the market, likely in the first 3 quarters, if history plays. Okay. So that was kind of depressing. So what can we feel better about? And on this next slide, I will once again say, I am not expressing an opinion on politics. I am telling you how the stock market perceives things. There is a ton of money that's about to enter the economy from the federal government. There is still a lot of infrastructure money coming out. I mean, you drive by a lot of the construction going on here in Central New York, you'll see the sign funded from infrastructure bill. Still billions and billions of that coming in. The IRA, the Inflation Reduction Act, they did get rid of some of it, but there's still a lot of money that's being distributed. And of course, here in Central New York, we're aware that the CHIPS Act, that money's not even hit. Micron, I don't believe, has gotten a cent from the federal government for anything. So that's all going to be flowing into the economy. That's going to be stimulative. We're also going to see probably the biggest year ever for tax refunds. because the no tax on tips, the no tax on overtime, and the extra standard deduction for people over age 65, that all kicked in at the beginning of last year. The refunds will be coming in April. That will help add to the economy right there. And finally, with some lower taxes and things, there will be some adjustments leaving more money in people's paychecks. So what do I hate about this? Government's running enormous, unsustainable deficits. And long term, I don't like this. Short term, for your money for this year, this provides a lot of support for the economy. And then finally, there's been a huge amount of deregulation. I think it's come in the past 6 months. I think you're going to start to see the effect on that coming up this year. So there's been huge deregulations in banking stocks. That's why there's a good chance we might be buying you some more banking stocks out there. But it's really deregulating across everything. Again, not taking an opinion whether it's good for society or bad for society, but what I can tell you for a fact is deregulation usually means very good things for the stocks and the companies that are getting deregulated. Second, this is either the single most positive thing I'm going to show you or the second most important thing. So one of the two. And this looks at earnings for companies. So what we've seen here, these last couple of years, when we've seen the stocks do well, we've seen the earnings of companies go up 11% in 24, and last year they went up 12%. Going forward, we are expecting this year earnings to go up 14.5%, and the year after about 14%. And this is somewhat consensus. We're not pulling from things that are really out of the ordinary here. Most experts think we're going to be 10% or higher earnings growth the next 2 years. Here's what I know. In the end, a lot of things affect the stock market, but in the end, it should be about a company and their ability to make money. If the company is increasing their earnings by 14% in a year, logically, the stock price should go up 14% and become more valuable. So a lot of this is people worried that there's smoke and mirrors. There's not. Corporate earnings have come up in a big way. Stock prices should reflect that. And we continue to think corporate America is on really solid ground. As a matter of fact, by almost every metric, it's about as solid ground as it's been on. What's important to it? Consumer spending. I heard a lot of people say the consumer's not going to be able to keep spending. It's not in the numbers. This is inflation adjusted, and it shows you median household income. It comes from the Census Bureau. This was released back in September of 25, so a few months ago. What it showed is inflation adjusted, the median household income in the United States is $87,539. That's the highest median income we've ever had. And again, these numbers are inflation adjusted. So highest we've ever had, certainly higher than we were when we were 75,000 back in 2000. What this means is, and again, inflation adjusted. People have the money to spend. I have great confidence in the American consumer that they'll spend the money. I do not see a recession this year. In a minute, you'll see why that's so important. The other thing I've heard is people can't afford things or taking on too much debt. We are at record levels of debt. That's true. But the most important thing is, can people afford the debt? So that comes down to is, what's their monthly payment as a percentage of their take-home pay? This is a chart, and it shows you it going all the way back to the 1970s. And what we see is certainly back during the housing bubble that we had before it burst, that did show you consumers, we were way too extended. The bubble burst. It was really bad for the economy. Look where we are right now. I mean, we're right about the average household spending about 11.5%, not even, of their take-home pay on debt service. When I look at historical levels, I got to go all the way back, well, prior to COVID causing disruptions. I got to go all the way back to 1990s for that. Long story short, the consumer, if they want to keep spending, they can afford to, and they've not taken on too much debt. Now, I'll put a caveat on. There's parts of the economy where that's true. There's certainly some consumers that are in big trouble and struggling, so I'm not saying that's not happening. But on a macro level, which is what the market runs off of, things look good, look healthy for the consumer, their balance sheet, and the money that they are making. So this brings me to what I think probably is the most important thing for this year, and that's the Federal Reserve. So we talk about the Fed lowering interest rates, and I'll talk about that in a second. But I want to point something out to you also. This is the money supply in the US. So essentially, traditionally, the Fed is using their powers to essentially print money. There's other more complex ways, but that's really what's happening here as you see the money supply going up. What we saw here is after COVID, to slow things down, not only did the Fed raise interest rates, they actually decreased the money supply. And as you can see from this chart, that doesn't happen. So that was a huge headwind against the economy, because when there's fewer dollars to run around out there, it's harder to grow the economy. What's the Fed done now? Just the last couple months, they reversed course. They are now no longer shrinking their balance sheet. They are adding to their balance sheet, which essentially is they are printing money. That, again, is stimulative to the economy. I find it difficult to believe with the Fed reversing that. And if they continue to lower rates, I give it, I mean, the odds of us being in a recession this year are very low. So why is that important? So this is probably the simplest slide I have. When the Fed is lowering interest rates, if we go into a recession, the stock market tends to lose money, down on average about 3% a year. So just the Fed lowering interest rates doesn't mean the stock market goes up. Matter of fact, most of the time it means the market does go down because the Fed was too late and started lowering rates too late. But what happens if it wasn't too late and we don't go into recession? Almost 100% of the time, the stock market is positive. Average return, 18%. So I got the Fed, once again, helping with their balance sheet and expanding the money supply, and I've got them likely lowering rates at least twice the rest of this year. And I think that because obviously Trump is going to put in a new Fed chair that will be predisposed to lower rates. So barring that inflation number really coming up, which I'm not expecting, I think the Fed lowers rates. I don't think we go into a recession, and my history tells me we should make money. Okay. One other thing that I think is encouraging, because there was concern about the AI bubble, how it was just tech stocks that were doing really well. We've seen this expand now to other parts of the market. So on your reports, you'll see your large value stocks have now done almost as well as your tech stocks. If I ran you the past 3 months, they've done a lot better. So if we went back here to November, and we took a look at cyclical stocks. So these are kind of boring stocks that rely on a good economy, and we compare them to the S&P 500 overall. What we see is cyclicals have actually picked up almost 10% in a very short time period. That's the stuff that hadn't been moving. That's really encouraging. The S&P up 4 over the same time period. What I don't have on this chart is tech, but if I did, here's how it would look. Pretty much 0 to negative. Tech over the past few months has done nothing. The stuff that hadn't been doing well is turning and doing well now. That's a very healthy sign for the market. None of us want to see a market relying just on technology. So seeing the earnings coming, seeing the expanding of what is actually going up are all healthy signs. Again, we are fighting, though, a midterm election pattern that is a tough one to fight. So wanted to get you off in by 4:45. So my thing says I'm at 4:40 right now. So what are my conclusions here? Number one, your fundamentals here remain very strong. It favors a strong market. Again, the corporate earnings look good, growth looks good, all that stuff that we would normally look at. We're also seeing that this won't just be a technology rally, that other stuff is starting to move. Again, I think it's good. Here's the key. Hey, if I'm wrong and the Fed does not cut rates, you can throw out a lot of what I said. That's a problem. But that also, I think, means inflation is causing issues. I think the Fed cuts 2 to 3 times, at least 2 times. Again, it does that. We don't go into recession. It looks good. Tariffs, they're still going to be in the news. We're still going to talk about them. We'll hear about them all year. The market is not paying as much attention. It's moved on to other things. Again, not saying it doesn't influence, it's not important, but it's become more marginal to how stocks perform versus last April when it was the determining factor. So here it is. We are predicting a 10 to 15% return positive on the stock market, likely back-end loaded. As I said, though, there's going to be a time period where it's going to drop and you're going to go, oh, yeah, Rick said it's going to drop 15%. But at the time, it doesn't feel like it's only going to be 15%. It's going to feel like it's going to keep going because that's how every 15% drop happens. But we would expect it. It would be unusual not to have a relatively significant drop at some point this year. But as you can tell, I'm optimistic. And if you watch the one I did for last year, I thought we'd get high single-digit returns last year, so the market did better, but I was much more cautious. I was worried about a lot more of the unknowns. Feel better about where things are and our ability to see how the economy is going to perform here over the next year. So again, it's not all sugar plums and whatever, candy canes. I don't know. Christmas is done. You get the point, though. It's not all great news, but I think the positives do outweigh the negatives there. So that wraps up my official remarks here.
Download the WSYR Plus app on your TV to stream News Channel 9 for free. Just go to your smart TV, search WSYR Plus in the App Store, and download to start streaming today.